Hello, welcome to Retire Smart Magazine. My name is Steve Sexton, and this is the Saving with Steve segment. Today, we're going to be talking about how to financially survive this pandemic. You know what? When it first started back in February and we all started going into lockdown, so to speak, in March, we saw the social distancing companies. I'm talking about restaurants, retail, entertainment, travel. Their businesses just came to a halt. Okay. And over the last, 6, 7 months, we have seen those industries begin to have a portion of their business working, like 25% in a restaurant. You haven't seen theaters open. Some have actually gone bankrupt. Retail, they've actually seen it's gone bankrupt. So there's going to be some unemployment there. Okay, we are all hoping for an antigen, a vaccine, so we can move forward with our lives. But until that occurs, we're stuck with what we have, and quite frankly, we don't know how long it's going to last. It was great. The last quarter was wonderful economically, but we're starting to see cases come up, and depending upon how the governors and the politicians in each state handle this, we could be going down on certain types of lockdowns. So it's really important that we pay attention to our finances so we can help ourselves get through this. So what I've done is I've created a 10-step guide to surviving this pandemic. Now, number one, okay? What we want to do is, to coin the phrase, is flatten the curve when it comes to our spending. So what you want to do is list all your expenses on an Excel spreadsheet or piece of paper. Start with all the credit card payments you're making, the mortgage or rent payment, the car payment. Get into, hey, this is what my cell phone bill costs. This is what my cable bill costs, my utilities. This is what I pay eating out, whether it be whether it be In-N-Out Burger or just eating out dinner somewhere or going to Starbucks. List those all. How much do you pay in food? Then list all the little apps that you have that you pay for, whether it be a fitness app, a fitness membership, a wine club membership, meals out, whatever it is. Write it all down. And then what I want you to do is go by the lines where it says, hey, I need to eliminate this expense, right? Eliminate, okay? So if it's the wine club memberships, the fitness memberships because you're working out at home, whatever it is, get rid of the things you're not using or the things that are not essential to you, okay? Next, you want to look at things like your mortgage, okay? Your mortgage, your cable, your cell phone bill. Why? Because you can find better rates. What I mean by that is we went from $270 a month on cable down to using just internet and AT&T Live, and we get the same stuff for $154 as opposed to $270. Over $100 savings. When it comes to the cell bills, hey, the top 5 are pretty expensive, but you can get a carrier that's on the same network. Okay, the same network. Instead of paying $50, you can pay $25 or $30. So for us, for a family of 4, it saved us $80 a month. So every little bit counts. When it comes to eating out and all that kind of stuff, plan your meals. You can do better at planning your meals. You can save money. Get the family involved. When it comes to entertainment, hey, the good old-fashioned board games aren't bad. You know what? Having Zoom meetings, having Zoom cocktail parties, that's not a bad thing either, but it reduces your spending from going out. Next, don't use or eat up all your credit, okay? You're going to need credit to get through this, especially if this is extended, okay? So if you start going after your credit now, banks will realize that, especially if you're only making minimum payments, and they'll reduce the amount that you have the ability to borrow or take from your credit card. It would be a good idea to look at how you can get some additional credit because you might need that later on. What I mean by that is taking out an additional credit card but putting it in the closet until you need it, or taking out an equity line or a personal equity line where you're not being charged interest on that equity, on that personal loan until you take out money. So talk to your banks, look at that, make sure you have this little extra cushion because you might need to go to it. For those people who have been laid off, hey, get in there and get your unemployment filed as soon as possible. Next thing when you're looking at this, the reason why you want to get that filed is because you want to get money coming into the household as quickly as possible to eliminate that stress you have on your savings and other accounts. So when you look at that, you also want to look at, hey, how do I find a job that I can bring in extra money? Now, some people have gone to Uber, Lyft. Some of my clients are realizing that they have to take the skill set that they have, even though they're not in a technology business, and apply that and see how they can apply that to an Amazon. I've had a number of people get positions at Amazon and other companies that aren't requiring social distancing to get a job, but it's not their dream job. It's not where they were before. They're not making the income that they had, but they're still making an income to cover their bills and not have to take money from their accounts. Now, you want to maximize your savings as number 4. And the reason why you want to maximize your savings is this, because you want to get the most out of the dollars that you're saving. If you're on unemployment and you still have the ability to save. If you're still employed and you don't know where this is going to go, whether you're a teacher, whether you're a public employee or a private employee, and you don't know how it's going to go, you want to save as much as possible. Build that emergency fund as high as you possibly can. And you know what? In order to do that, you want to have the best account that gets you the most amount of money. And what I mean by that is you want to take a look at the banks. You can source them online. You can take a look at credit unions, savings loans, even insurance companies. They all have money market type accounts, which will pay a specific interest, and you can have the ability to access your account whenever you want. Now, I've seen the interest rate as high as 1% on a money market and as low as 0.01. So research it. It can make some difference for you. Okay, the next thing is you want to prioritize your bills. If you're in a situation where not that much money is coming into the house and you don't have a lot of savings, you're going to have to prioritize your bills in order to figure out what makes sense. What I mean by that is obviously you got to pay the rent or the mortgage. Then you got food, you got utilities, okay? You know what? Then you want to take a look at those bills that have the highest interest rate or penalty if you don't pay, and pay them accordingly. Next, credit, okay? This is a tough time for everybody, but it's not the time to go and hide or go on the lam from your creditors. If you're in a situation where COVID has adversely affected you, you want to talk to your creditors. For example, with your mortgage, you have the ability, if you have Freddie or Fannie, to get forbearance. So that could be 6 months worth of forbearance where you don't have to pay your mortgage, or a year's worth of forbearance. Some allow you to add the interest payments to the end of the mortgage. Some will say, hey, you have to pay them at the end of forbearance. I've got some people that we have talked with that have taken out, they utilized the forbearance, and what they have done is the forbearance is for 6 months, and then they have to pay back all the payments at the end of the 6 months. So what they've done is they've taken the forbearance. After 3 months, they put their house up for sale. The house sells, and then they pay back the forbearance, but they also have a lump of cash. This way, they won't have to short sale or get foreclosed on, but it allows them to take the equity in their home and have some relief. When it comes to credit cards, it's very important that you take a look at this and you call your credit card company. Don't hide from them. Let them know what's going on. Why? Because they understand there's an issue. And many of them have forgiven a portion of the person's debt, their balance, okay? They've also reduced the minimum payment and the interest rate. Why are they doing it? Because they don't want you to default on the whole balance. Not all of them will, but a lot will, so you want to call because you never know. Same thing with your car company. Talk to the company. Let them know what's going on. Hey, I need some forbearance with this. Hey, you might have to pay things back in the future. Whatever the case may be, find out what it is, okay? But if you can communicate with them, they understand there's an issue. Quite frankly, the mortgage company doesn't want your house. The car company doesn't want your car. The credit card company doesn't want you to default, so they're probably willing to work with you, okay? Now, one of the big things here is this. As a last resort, dip into your retirement retirement accounts. Why? Couple things. One, if you dip into your retirement accounts, you're going to lose the ability to compound, because what people don't realize is you put money in there that you didn't have to pay taxes on. You're earning interest on top of money you didn't have to pay taxes on. And you're earning interest on top of that. So it's like triple compounding that you're giving up for every dollar you take out of the retirement account. So it's important that you start with accounts that are savings, checking, CDs, the ones with the lowest interest and the least taxable impact. Then you want to go to the capital gain items, such as stocks that you own that you'd only pay that 15%. In fact, if your income is less than $80,000 a year, you'd be in a position where you wouldn't have to pay tax on any capital gain item as well. And then, last resort, we go to the retirement account. It's important that you do this properly and think about it. You know what? If you have been laid off and need to dip into your retirement account, just dip into what you need on a monthly basis. If you haven't worked since February, that means your income's not going to be all that high. And that being the case, you really want to take a look at the taxable impact of what you take. Now, you might not need to defer it all the way until 2022. You might pay next to nothing in taxes this year, so you really want to talk to your CPA over the next 2 months if you have been doing that. Okay, be on high alert for scam auditors. All you need to do is look at the SEC the Securities and Exchange website, IRS website. There's a lot of scammers out there. They're trying to get people to take money out of retirement accounts or borrow money against their retirement accounts to put in accounts that they say are going to get really high interest rates with low risk. Somebody says that to you, it's a red flag, okay? We had one of our clients be in that situation, and they came into the office, and the person brought in what's called a private placement memorandum. And we looked for the name of the company in this private placement memorandum on the Securities and Exchange website, couldn't find it. When we looked at the individual, turns out they didn't have any securities license. So, big red flag. They decided to not move forward with it. But at the same time, we provided that information to the SEC so they don't scam somebody else. So it's really important you look out for them. And the last thing, we all don't know what's going to happen or how long this is going to last. So when you look at buying a new house, I know financing is cheap. But if you're in a situation where you lose your job in a year, yeah, you can get 6 months forbearance or a year. But you could be in a situation where you put all that money down where you lose that house. Okay. Second thing is houses are selling at or above asking price. That means we're at the highest limits. So it's really important that you pay attention to this situation, because if you buy that house at such a high rate or a high price, and then you lose your position and the housing prices go down, you would be upside down and you really wouldn't have any equity there. So it's really important to make a prudent decision before you make a large purchase, okay? Or have some out. Like, for example, Ford Auto Finance is giving people the ability, if they buy a car and finance through Ford, and they lose their job in a year, they can return the car. Now, you have to understand the consequences of that. Hey, you lose your car, you lose your transportation. So it's important to take a look at that. Now, we went through 10 items. Cool thing about this is only 10, 12 minutes long. You can see it again and again, so you can make sure you get all 10 items. So it's important. We want you to survive this financially, health-wise, the whole shot. Now, this is Retire Smart Magazine. My name is Steve Sexton, and this is the Saving with Steve segment coming to you every Thursday right here at 10 o'clock, where I'm going to give you my best advice to help you retire smarter. Be safe. Have a wonderful day.